everyone. My name is Rowan Petts, the Executive Director here at the Australian Chamber of Commerce in South Korea. In light of the many changes to taxation rules and regulations, returning to Australia after working abroad for many years can be quite stressful and a drawn-out process which requires careful planning and consideration. To get the best understanding on how to prepare yourself and maximise your financial potential, it is my pleasure to introduce today's webinar, an insider's guide to understanding taxation for Australian expats and how to take advantage of the key opportunities for your financial future. And I'm joined today by two industry leading experts on the topic, Nathan Andrews, Senior Wealth Manager at Skybound Wealth, and Geoff Taylor, Partner and Australian Tax Expert at Magenda in Sydney. And with that, it's my absolute honour to hand it over to Nathan to start this presentation. Hello, Nathan, and hello, Geoff.
Good day.
Hi, Ron. Thank you very much. Okay, so hi, everyone. Welcome to our Australian tax and financial planning webinar. As Rowan said, my name's Nathan. I'm based out of Switzerland, Geneva, for Skybound Wealth Management. And I'm joined today by our close colleague, Geoff Taylor, based out of Sydney, Australia. Hey, Geoff, how's it going?
Yeah, going well today.
Good, good. Okay, fantastic. Okay, so the next slide, please, Geoff. Okay, so we're very grateful today to Rowan and everyone, AustCham Korea, for this invitation to participate in this event. So most of our audience out there, you will be based in South Korea. There may be some attendees from elsewhere, so welcome to everybody. The core content of this presentation today is relevant for all global Australian expats worldwide. So we do hope you find it an informative and useful presentation. I'm sure some of you may be thinking, Nathan, a British chap based out of a Swiss office, what's the relevance here with Australian tax? So the key thing is at Skybound, we are essentially international financial planners. So we work with professional expats all across the world, typical nationalities being Brits, Australians, Americans, and assisting these people with arranging their finances in the most secure, tax efficient and profitable ways. In recent years, we've had good success working with Australian chambers through the likes of Switzerland, UK, some other countries also. And I was delighted on a recent business trip to Korea, visiting existing clients, whereby AustCham Korea allowed us to participate in this today and essentially bring services of Geoff and myself to expats in Korea. So that's great, thank you. Next slide, Geoff. So as an international company, we work together with experts from all across the world. So for Australian tax purposes, our contact is Geoff Taylor, based out of Sydney, Australia. So Geoff, would you like to quickly say hi and introduce yourself?
Yeah, so my background in looking after expats goes back some 18 years. I've actually done 75 seminars in 15 countries, and this makes it number 16. So I started out originally in the Middle East, looking after clients in Qatar, UAE, Saudi, and have now moved on to do seminars in other countries around Asia, and more recently in Europe and the UK. So I've done a Masters of International Tax at Sydney University, which has given me my technical background. I'm an Australian financial planner. That means that I can only advise on financial planning matters in Australia, but not overseas. When I'm overseas, I'm doing the tax advice and assisting people like Nathan. I think I've had about 3 years experience with Skybound Wealth. Excellent company to work with. I've done a lot of seminars and webinars with them in other parts of the world. So very happy to be bringing this presentation to Korea.
Okay, thanks, Geoff. Fantastic. Okay, next slide, please. Okay, so as for myself, based out of Geneva for Skybound, I've been advising expats globally since 2008, predominantly across Asia and the EU and more recently Switzerland. Typical areas in which we work with people would be advice for essentially medium to long-term financial planning, cross-border taxation issues, savings, investments, and general asset management. As mentioned previously, the key clientele are typically Brits, Australians, and Americans, and we can provide all range of services and advice for such people worldwide. As an independent company, we deal with about 300 partnerships worldwide, these being anything from private banks to retail banks, insurance companies, pension providers, whether they're European, Swiss, superannuation funds, a whole range of services for clients. So the next slide, please, Geoff. So our aim is essentially to understand the client's needs, formulate a plan that's in line with their medium to long-term financial objectives, considering things like taxation, security of assets, flexibility, and so forth. As a company, we have just over 10,000 clients worldwide. We manage just over the up-to-date figures, about $4 billion in excess of that. In terms of advisors, we have around 80 advisors worldwide, advising professional expats. Our parent company being Skybound Capital, some of you may be familiar with, based out of South Africa. And we have 7 active advisory offices currently. If we can go on to the next slide, please, Geoff, we can see geographically where we're located. So you can see in dark blue, the Skybound offices currently out of the US, UK, Switzerland, EU, and the Middle East. Planned expansion, we're rapidly developing as a company, and we're looking to set up in Perth in the coming years. Our parent company, of course, based in Brisbane already, and our partners are based further afield again on top of that. Okay. In terms of regulations, licenses, this of course is very important in terms of financial advice or managing money. So typically we are locally regulated in all of the offices in which we operate. So for example, the UK, we have the FCA, Switzerland, RF, regulator for Switzerland. Middle East, we have both the securities and the insurance licenses. We acquired the SEC for America in 2021, and more recently we've become appointed representatives under the ASIC license for Australia. So that essentially means we can advise Australians going home and continue that service. Continuity of service is of paramount importance to what we do. We are really medium to long-term financial planners, and working with clients over the years, helping them to get the most out of their money is very much what we do. Okay, these licenses, very stringent regulators, places like Switzerland, UK, US, they essentially allow us to do a lot of cross-border planning and go into other territories that are not on that list, so we can advise in certain other key areas. Okay, thanks, Geoff. So the next slide, so who is the client? Who is the typical Skybound client? Sorry. So our clients essentially fall into 3 categories. First of all, we have clients who are in the wealth accumulation phase. So these may be people who are really just starting out with financial planning. They're looking to build towards a pension for the future. Maybe they have young children. They're looking to fund sort of university costs further down the line. Obviously, as expats, whilst we get looked after in many respects, a lot of the time we have to fund these things ourselves. So planning for those sorts of things, just getting a bit of structure really of the finances, and that may be for target things later in life. Okay, the second category of client would be for those who maybe have some existing plans in place, sort of in the medium stage of financial planning. They have some investments, maybe it's just a case of optimizing those, addressing those, how they're working, how they're performing, are they structured in the best way? Are they in consideration of future tax and all the rest of it? So a little bit more structured, but again, typically things like pension planning, capital growth, preservation, that sort of thing. And then the third client, these are sort of clients, maybe 2-3 million plus, more in the sort of higher net worth category. these are typically people that may have enough wealth to essentially fulfill their financial dreams, but is it structured correctly? Do they have assets that can produce an income? Will it be a tax efficient income? Are they satisfied with investment growth, performance, and the security of their overall assets? So in terms of a typical client, these very much cover who we work with. Okay, and the next slide, please, Geoff. So here's a very lucky chap, looks a bit distressed, but he's managed to do quite well for himself over the years and built up considerable assets. So indeed, these are all areas that we advise on at Skybound. So Swiss pensions, European, UK superannuations, private investments, bank accounts, life assurance, a whole host of areas. Crucially, a lot of our expat clients, as they approach retirement, maybe 5, even 10 years off retirement, they tend to have worked in maybe 2 or 3 countries globally. So it could be a case whereby they have multiple assets. They maybe have a couple of pensions from previous employers on various countries. They may have international property, savings accounts, investments. And as they approach retirement, how are they actually going to put all these things together in a secure fashion that can produce an income and give them essentially access to their wealth? So that's very much what we do at Skybound. Okay, and the next slide, please, Geoff. Okay, and just various awards that we've won recently, including excellent investment advice. I'm not going to talk any further. I'm going to hand you over to the interesting part of today's presentation, being Geoff Taylor and an insight into Australian tax. Okay, thanks, Geoff.
Thank you. So what I'm going to cover today, sadly, there's probably more traps than tips around Australian tax, and things have changed pretty much over the last 10 or 11 years as the federal government has tightened the net in different ways. But there are still some opportunities for tax planning, and so that's what I'm going to cover today. Just a general advice warning. So this is doesn't take account of your own personal circumstances, goals, or objectives. If you did want any advice, tax or otherwise, you're best to see us privately. So what I'm going to cover is change of tax residence, and this is a big deal and needs to be planned well ahead. So if a client comes to me a week before they're about to come back to Australia and wants to plan their tax residence and wants to know what to do, often that's not quite enough time to prepare. Usually 6 to 12 months is a good amount of time. I'm actually doing a financial plan for a pilot who's based in Zurich, and he's not intending to move back to Australia for about 2.5 years, but he wants to know all the ins and outs of his Swiss tax position and pension position, as well as his Australian tax position. So I'm doing the Australian piece for him. So I'll cover off what leads to a change of tax residence, what sort of issues you need to consider, and then how you will be taxed when you come back to Australia. The superannuation system, if you've been away for a long time, will have changed a lot. If you haven't been following the changes, it's still a very tax effective way of saving for your retirement, but it's not the only thing. So many of my expats over the years have invested in personal portfolio bonds, which is the type of product that Nathan, or one of the types of products Nathan will cover today. So it is a realistic part of someone's retirement strategy to consider one of those products. So usually what my focus is around tax optimization for a client prior to moving to Australia, and then looking after their finances when they move back. So it's interesting, having looked at the tax residence rules of different countries around the world, there are some common themes. So this notion of 183 days being half a tax year, that will get you in the tax net in many countries and does so in Korea. So if you've been in Korea for quite some time, you're probably already tax resident, you probably know all about this. But if you're going to change tax residence, you could trigger tax residence in Australia and still be tax resident of Korea at the same time. And so that that will have consequences. And what I'm going to explain to you is how you deal with this via the tiebreak rules in the double tax treaty. So basically, the residency rules, 183 days, looking at where you actually live. These are similar principles to are used in other places. Some tax residence rules are very complex, like the UK, where you've got a whole range of like a complex calculation. This is a bit more vague as you would think of it, but I think it's fairly easy if you engage a tax professional that they'd be able to figure out at what point you trigger tax residence in one jurisdiction over the other. So if we look at the Australian tax rules, so we've got a 183-day test, but I guess the main test is the resides test, and it just basically means where do you live. So if you fly into Australia for a month on holiday and you don't have a permanent place to live and your family's still back in Korea, then you won't have triggered tax residence under the resides test because you're still living overseas. If you come back 2 months later with a container load of all your personal effects, you've shipped your dog and other pets back to Australia, your family comes back with you, you move back into the house you used to live in, it's pretty obvious that you now reside in Australia. And under Australian rules, we would regard that as triggering tax residence. The way that is advised to the tax office is just simply putting a date in your next tax return as to that date. So it's left to the tax professional and yourself, the taxpayer, to decide when you've triggered tax residence. The second test is, as Australian citizens, the default, if you like, is that you're tax resident of Australia unless you've got a permanent place of abode overseas. So if you've got a permanent place of abode in Korea and you're living there permanently, obviously you don't trigger that test. But once you cease to have a place of permanent abode in Korea, well then you could be tax resident in Australia. So this raises the question of, what if I'm on holiday? What if I don't actually have a permanent place of abode anywhere? Well, then theoretically you could be judged to be tax resident of Australia. The 183-day test, another test, if someone comes into the country, they could be triggering tax residence if they're here for more than 183 days. So effectively all of these tests are applied, and if you satisfy one of these tests, then you'd be tax resident of Australia under our rules. The superannuation test really only applies to diplomats and people in a particular type of superannuation scheme. So if you think about diplomats that travel around the world, Australian diplomats, they will be tax resident of Australia till, the day they die. So if someone was coming back to Australia, I would apply these rules, work out whether tax residence has or is going to be triggered, and then basically we work out whether the treaty is needed or not. Now, for those that have been following news on tax matters in the last few years, you may have come across the fact that Josh Frydenberg 2 years ago in his budget announced proposed Australian tax residence rules changes. And these are about the most dramatic changes you can imagine, because they've got a 45-day test. So 45 days and 2 factors and you're in. And this is quite dramatically different to 183 days or the test we've just seen on the previous slide. So then you might be saying, well, why hasn't it come to pass? We're 2 years down the track, more than. Why hasn't it come to pass that we're now applying these rules? And the answer is probably partly the parliamentary draftsman doesn't have the resources, and partly because it's a big change and this is going to be resisted by many expats around the world. There's going to be a lot of lobbying around this change because it is so dramatic. So people that are based in territorial tax systems or in no tax systems like the Middle East, they could literally trigger tax residence in Australia after being physically present for more than 45 days in a given tax year. If they had the right to reside permanently, they were citizens, that would tick tax factor 1. If they had access to Australian accommodation, if any of their family members were here, wouldn't be too hard to trigger those 2 factors. And if they don't have the benefit of treaty to use, they'll be tax resident and taxed on their worldwide income. This is quite dramatic for someone who's been living in, say, Hong Kong or Dubai for a long period of time, has been able to come down to Australia and have a nice holiday, hasn't had to worry about the tax residence rules. Well, when this rule comes into legislation, they will. So it will come into force from 1 July of the year after the enabling legislation is passed. So the earliest possible date is 1 July 2024. I can't see how that can happen for 2024 at this rate of progress. So it's out there in the future. There will be exposure drafts. There will be a lot of lobbying. So you're going to hear a lot more about this change, and we'll be running more seminars closer to the time. So the interesting thing about this rule is that even if Australia effectively makes it a much tighter determination of residence, if you live in a country where there's a double tax treaty with Australia, you can still rely on the tiebreaker to say, well, in the case of Korea, I've got a permanent home, or I've got personal and economic relations that are closer to Korea than they are to Australia. And so this is Article 4 of the Australia-Korean double tax treaty. There's other double tax treaties that include citizenship. They also include the ability to have the matter settled by a local tax authority. This treaty is an older version, so it doesn't have those elements. It only has permanent home and personal and economic relations. So the key thing is not to get yourself in a situation where you have to apply these rules and have to figure out whether you're tax resident of one country or the other. You should plan your change of residence to suit your personal situation. I've got a note there around the multilateral instrument, because normally under the previous rules, tax treaties didn't change very often. Now the multilateral instrument is changing a lot of things. So it is important to be aware of whether that might change any treaty benefits that you might want to rely on. In this case, I don't believe it has, but it is something that has to be considered. So if we think about becoming tax resident of Australia, ideally, just as one sort of thing to note is you want all your salary and end of service benefits paid before leaving Korea. Otherwise, the Australian Tax Office will tax on a cash receipts basis. So the last thing you want to be receiving is deferred compensation or deferred benefits after you've triggered tax residence in Australia. So that's just a simple tip. If you've got an employee share scheme or some sort of deferred compensation, this is something to watch out for. If you've got overseas property assets or even Australian property assets, you should look at valuations as close to the date of triggering tax residence, because these are coming into the Australian tax net. I've got a client who's coming back from the US. In a few months' time, he's got lots of properties overseas, including the UK, the UAE. He's going to have to get tax valuations on those assets. They will come into the tax net in Australia. You will get a 50% discount on the capital gain if the property's held for more than 12 months. Believe it or not, foreign currency, if you hold US dollars, pounds sterling, other foreign currencies that add up to more than 250,000 Aussie, and you make a gain after you trigger tax residence, that's in the net as well. Equally, if you lose money on the currency, you can claim a tax deduction. So these are some of the little tips and traps to be aware of. And this is why it pays to think about what you need to do before you trigger tax residence and then what you might do thereafter. This is probably the most dramatic change I think I've seen in my 40 years of being involved in tax, to just take what used to be a main residence exemption, so a capital gains tax exemption on your home. So your home's sacrosanct in Australia. Your home plus up to 2 hectares of land is not subject to CGT if you're a resident in Australia, and there's a further 6-year exemption if you move out and don't establish another main residence. But if you go overseas and you sell this property while you're overseas, any pre-existing exemption entitlements are gone. And this is extremely dramatic. We have had one case where the client didn't get tax advice from us, but had to sell a property due to a divorce. There was no carve out in that particular case, and the bill was $400,000 to the tax office. Whereas if the property had been sold before the taxpayer had left Australia, then there could have been no tax. So this is a very important change. There was 2 attempts to get it through. I think the Hong Kong Chamber and various other chambers resisted it hugely, lobbied hugely, and it still didn't get struck down even through an election and back out the other side. So the only way you can get around it is really wait until you're tax resident of Australia again to sell a property that's got any existing or pre-existing exemption entitlements there. So that is the biggest trap that you need to be aware of. So as I said and alluded to in the previous few slides, you're basically on the hook for your worldwide income, pretty much the same as or similar to Korea, and all of the different sources of income will be subject to tax, except for superannuation, which is obviously taxed in a concessional way. If you get a foreign pension, it will be taxable in Australia typically because the treaty says it's taxed in the country of residence. So if you think about all the assets that you may have accumulated, and typically expats can have UK pensions, they might have a 401k in the States, they might have an IRA in the States, they might have an RRSP in Canada because they work for 3 years in Canada. What do you do with all of these things? This is where you need advice. I guess the longer an expat's overseas, the more countries they go to, the more complex their situation will be my general take on it. So it plays to be thinking ahead. Australian tax rules, a little bit better. We are due for tax reductions from 1 July 2024. So those 32.5 and 37% bans are gone. And these came in under the Morrison government. Albanese's decided he's going to keep them because he knows there'll be too much of a backlash to not take them away. It's really just a reversal of bracket creep anyway. So you can look forward to come back to that 30% bracket from 45 to 200. Don't forget the Medicare levy, which has got nothing to do with Medicare or any sort of health entitlements. It's just another tax. So tax planning in Australia, there is still things like electric cars are now not subject to FBT. There's some tax planning options available, work from home expenses, various other things. Negatively gearing is still allowed. So there's still some level of tax planning that is possible. Every time I look at this slide, I have to update it because something has changed. Just in general terms, there's various ways to get money into the superannuation system. If you've been overseas for a long time, you possibly would put in 110,000 of what are called non-concessional contributions, and you can do 3 years in one go, which counts the 3 years entitlements. Once you're back in Australia, you're probably going to want to make the 27,500 if your marginal tax rate's more than 19% to get the tax deduction. It's only taxed at 15 on the way in. As you may recall, 15% tax on income inside super whilst you're in the accumulation phase, 10% on capital gains. The key change that's happened recently is the transfer balance cap has now been moved from 1.7 million to 1.9 million, all in one fell swoop. And that will stop you from, once you get to that, it'll stop you from doing any more non-concessionals or even downsize of contributions. So that's effectively what people are working towards in Australia to try and get to that $1.9 million. If you're a couple, it's 1.9 million each. And then that transfer balance cap is the amount that you can take from the accumulation phase to the pension phase. So once you do that and you're in the pension phase, you're subject to minimum drawdown rates, which start at 4% if you're under 65 and go up as you get older. And this is to force money out of the superannuation system. It's supposed to be there to fund your future retirement. When you go from the accumulation phase to the pension phase, if you're retired, there's no tax on income, no tax on capital gains, and no tax on pension payments. So that's the magic to get to that point, but it takes a long time to get there. You can't really get access to your super until you're 60 in most cases, and then it goes on from there. So I do a fair bit of advice around topping up contributions, tax effective contributions, and then pension strategies for those that are ready to move into retirement. There is another trap, and I won't go into this in a lot of detail other than to say, if you're going to cash out your entitlements from a foreign pension scheme, you've got to take account of whether it does meet this definitional thing of, is it a foreign super fund under Australian rules or not? The tax office has developed the usage of Section 99B, which was never meant to be applied to foreign pension schemes, but the tax office is applying it because they think that early release disqualifies a foreign pension scheme from being treated as a foreign super fund. So there's a lot of complexity around this, and I do advice on this. But I guess the key tip is, if you're going to take money out of a foreign pension scheme, then you need to know what the tax liability back in Australia might be. Section 99B applies to withdrawals if a person is tax resident even for 1 day in any given tax year. So even if the money was withdrawn and sent back to Australia, and the individual triggers tax residence on the 29th of June, then they may be paying tax on this transfer. The alternative is just to take the pension and just pay tax on that when you're back in Australia. So some basic sort of repatriation strategies. Normally when Australians get to retirement, they want to have their main residence paid off. Clearly, as I mentioned a few slides back, don't sell the property while you're overseas. If you've had any pre-existing CGT entitlements, maybe simplify things when you're coming back. If you're going to actually work for another 10 to 15 years, negative gearing, I don't think the Labor government's going to attack it. It has been taken away previously a long time ago, and it caused a rental shortage in Perth and Sydney. So Keating reversed that very quickly. So negative gearing is still popular, particularly as interest rates are going up. For younger people under 50, I don't recommend putting a lot extra into super because you never know what's going to happen. From over 50 in the run up to 60, that's a key way to save. You can make contributions to super while you're overseas, so it is one way to ramp up while you're overseas. The foreign life policy is an unusual thing, a quirk of previous tax rules changes where the fifth rules were thrown out. Foreign life policies used to be taxed on an accumulation basis, but now effectively they're taxed like an insurance bond would be in Australia. So they're considered a tax-paid investment if held for more than 10 years. The section is 26AH. So this is a key savings vehicle for Australian expats. And if I go all the way back to the time when I first arrived in Dubai, clients have been investing in these types of products, whether they're savings products, whether they're lump sum products. And I guess they're, in some cases, multi-currency platforms. They have a lot of features that we don't have in our superannuation platforms here in Australia. So this is something that, and I'll get Nathan to go into this in more detail around these products. I can't recommend them because they're a foreign product, but I can certainly tell you the tax implications of investing in this type of product. Finally, if you do have a Korean pension or pension from a Korean employer, it is possible to have an application for the undeducted purchase price, which reduces the Australian tax payable. So that's just another little tip there. So usually when I'm assisting clients with tax repatriation strategies, I consider all of these types of things and usually work with Nathan to develop a comprehensive, multi-jurisdictional plan. So I'll just hand back to Nathan, and he's going to go through some more slides on his investment side of the presentation.
Okay, thanks very much, Geoff. Okay, so in terms of what should you be or what can you be investing in whilst offshore in terms of savings, financial planning, the two key vehicles, sorry, Geoff, if we can go back to the previous slide. Yeah, that's the one. Okay, so obviously on the right there, we have the Australian superannuation. No doubt many of you will be very familiar with this. As Geoff said, as an expat, perhaps ideally you should be looking at maybe contributing to this 50 plus, sort of age 50 plus. So I'm just going to talk about the two comparisons. So should you invest in super? Should you invest in something called a foreign life policy? So I'm sure Geoff will agree that the general advice on this is really you should be utilising both structures. Would you say that's correct, Geoff? If you're an Aussie expat, sort of saving, investing for the future, it's good to have both of these in place.
I think that's
But they are
correct.
different.
Yeah, there's limitations on how much you can put into the superannuation system at only 110,000 a year. So if you want to save more than 110,000 a year, or you want to delay topping up your super until you get back to Australia, you might skew more towards the offshore investments, and then increase the super closer to the time of coming back. But I think they both have a role. So the offshore investment is not going to have any tax, no Australian tax payable whilst you're overseas. So even if you put money in and you pull it out within the 10-year time limit that applies for tax purposes, it would still not be subject to any tax. Whereas you put it into the Australian super system, in the accumulation phase, it's going to be subject to the tax at 15 and 10, which has a drag of about 0.5% on a portfolio. So there's still a drag of tax, even though you're going into super. But I guess the reason to go into super is to ramp up in anticipation of the tax-free benefits that are further down the track. So it's a matter of balancing up the two.
Okay, great. So typically a super's a little bit different to other pensions worldwide. The idea of super, of course, as many of you are aware, is to provide a tax-free income in retirement. So as Geoff mentioned, contributions going in would typically be subject to tax in terms of income and capital gains tax. I think at 10 and 15%, Geoff.
Yeah, that's right. So when it's inside the vehicle, it's 15% on income or distributions and 10% on cap gains.
Okay, and then the idea being essentially a tax-free income from age 60 or 65, depending on your circumstances back in Australia. So this is very much the opposite to worldwide pensions elsewhere. Typically in the UK, Switzerland and other places, we get tax relief as we pay into a pension, but then we're taxed on drawdown later on when we're retired. So it's quite different in that respect. So as Geoff mentioned, you can contribute up to 110,000 a year into an Australian super. And this can be sort of backdated, so you can pay 330 initially. So an alternative, something you could also do in conjunction with an Australian super, is something called a foreign life policy. These have various names, sometimes insurance-linked bonds, international life bonds, offshore portfolio bonds. These are essentially investment platforms or investment structures that you may be familiar with already in respect of access to multiple currencies, good flexibility, investment choice. However, the crucial thing is they have an insurance wrapper around the structure, which gives the tax benefits and which qualifies for the ATO legislation in 2010 and the clause 26AH to give a tax-free income. So the idea of these is a little bit different to an Australian super. These enable something called gross roll-up. So gross roll-up is essentially you can contribute into these tax-free. Any growth is tax-free within the structure. There's no tax taken at source, unlike the Australian super, where income and capital gains are taxed at 10 and 15%. So it provides a tax-free vehicle in which to invest. But crucially, under the ATO legislation, if you hold it for 10 years, it's deemed that the tax has been paid. So what that means is, back in Australia, you could essentially access a tax-free income similar to the Australian super. So these two vehicles work very well alongside each other. In investment terms, having both also, of course, gives diversification. I'll come on to it in a minute, but the foreign life policies also have greater choice of investments. They're more flexible. You're not restricted to age limits where you can access the funds. And again, for a lot of our clients that are non-Australian or don't even go back to Australia or whatever they may be doing in their financial futures, we still advise on foreign life policies quite a lot. These are big, very attractive, secure, tax efficient investment structures for international expats around the world. Okay, so next slide, please, Geoff. So how did all this come about with the 10-year ruling? So historically, as Geoff has sort of touched upon, the Australian Tax Office had quite defined rules and regulations for how foreign investments, foreign life policies were taxed in Australia. In 2010, there was a repeal by the ATO of the fifth rules, which brought about some freedom. So the next slide, please, Geoff. So why the change? I think in honest terms, Australia, whilst there's been a huge influx of various nationalities moving into Australia, certainly from Britain in the last 20, 30 years, in terms of it holding money in taxation, Australia was deemed as quite an unattractive place to go to if you're a foreigner with a bit of wealth or whatever money you have because of the tax regime. So the Australian government recognised the fact that they wanted to attract foreign retirees. They also wanted to attract foreign professionals, skilled professionals to go and work in Australia. So they essentially looked at the fifth legislation, and in 2010, they wanted to make it a more desirable location for foreigners to go and live in Australia. So this essentially brought about the change. So foreigners going into Australia, we had more favourable, let's say, terms for our investments that weren't Australian type investments or savings. Okay, and the next slide, please, Geoff. So Australians abroad. So how can Australians who are currently abroad take advantage of foreign life policies? The key thing is to be outside of Australia when you open up one of these investment plans. You could literally be going back imminently, but the key thing is to open it up, and you can hold that when you get back to Australia. There are no issues with that. You can continue to invest in the structure. The key thing is don't think of access for 10 years, and then from 10 years after that point, you can have the tax-free accessibility. And the next one, please, Geoff. Okay, so just to finish up on the foreign bonds before we open up the floor for Q&A, just visualization. I'm quite a visual person, so I like to see things sort of drawn out. So how does a foreign investment bond work? So on the right there, we can see the diagram. As I mentioned, typical to a lot of investing that you'd be used to already, you essentially have an investment platform. So you can put cash could be on a lump sum basis. It could be small amounts of regular disposable income, a few $100s or even a few $1,000s a month. And that could be set towards a financial objective. Could be retirement, it could be just capital growth, whatever the financial objective is. So essentially you invest through the investment platform, and then you have the international wrapper or insurance facility wrapper around that structure, which gives you the tax deferral. A lot of these structures are also, they follow a system of segregated assets. So they're in jurisdictions which offer some of the highest levels of investor protection worldwide. So in terms of safety and security of assets, this is arguably, certainly for me and my finances, and for most of my clients, I think pretty much all of them, security of our assets is of absolute paramount importance. So these are very safe, global structures. Big names, big institutions tend to offer these. But the crucial thing is they have the insurance wrapper to make them tax efficient. So as I said, you can invest in lump sums or smaller regular amounts. There's a range of currencies available to invest in. Another interesting thing about these is that you don't have to be cash rich to invest in these. You may also currently hold a share platform, for example, a Swiss Quote share platform. I had a couple recently. They had various amounts in shares with Swiss Quote. They didn't want to get rid of the shares because they'd actually been given, I think the parents had given some of the shares to these clients. So they had a sentimental value, and they had no intention of selling these shares for certainly the next sort of 5 or 10 years. But Swiss Quote wasn't doing any favors for them. Typically, all they were getting is capital growth, which is fine. That's the idea of holding shares in the first place, right? But what we could do with structures like the foreign offshore bonds is, for anybody that has an existing share portfolio, you can also transfer these into these foreign structures or these foreign life bonds. So essentially you can retain the holdings, retain the shares, but they fall under the tax efficient wrapper for future advantages back in Australia. So, and typically you'll have all the key features like online access. Another thing is, should you be moving on to other locations before you retire, somewhere else after South Korea, these are sort of portable structures because they're able to be held in the same jurisdiction, and you have the freedom to move around the world, and in that sense they have portability. So we use these a lot for general financial planning for expats. Brits get a tremendous amount of benefits from these, not relevant to today's presentation, but for the Australians to have a future tax-free income or access to this after 10 years, that alone is better than a lot of the advantages for Brits going back to the UK. So these really are advantageous structures, whether you're investing, even if you're not going back to Australia, you maybe want to top up pension contributions. These can essentially offer you a pension structure without being a pension per se. They can be sort of flexible accounts that you can invest in and have access to your money in a tax efficient but secure fashion. Okay, so that just about wraps us up. Thanks, Geoff, for that. And for doing the slides today. That's very kind of you. So that just about wraps us up on today's presentation. Obviously, Geoff, the more technical Australian tax aspects, and myself, Skybound, how we can work in conjunction with Geoff, helping you to arrange finances securely and tax efficiently around the globe.
And with that,
Okay,
I think we're just about out of time. So firstly, I want to thank Geoff Taylor and Nathan Andrews from Skybound Wealth. Lots of information today, fantastic. But as always, financial advice is quite personal. And if you do have any follow-up questions or would like some detailed advice, I do recommend to get in touch with either Geoff or Nathan.